Staying power pays off. For gold holders. An article by Torsten Pollitt, published the 16th of February 2023. Perseverance is rewarded sooner or later, but mostly later. Wilhelm Busch. Market timing. Who doesn't want that? Sell when prices are at their highest and buy when prices are at their lowest. If investors succeed in such market timing, they can achieve substantial returns. But unfortunately, experience shows that only very few master market timing. Most investors fail to systematically sell high and buy low. This is not just an interesting finding but also an important one, as poor market timing can result in significant capital losses. To explain this further, here is a simple example, see Figure 1. Let's say you invest €10,000 in stocks. You buy 100 shares at €100 per share. After the purchase, you see the price drop, unexpectedly, to €80. Your book loss is €2,000, but you are holding on to your position. The share continues to fall to €50. You still do not sell. The shares continue to fall to €30. Now you are quite desperate and sell since you want to prevent further book losses. Your realized loss is €7,000. Then the stock goes up again. But you don't trust the market, so you don't buy it. The share price continues to rise, and you finally purchase the stock at €55. At this price, however, you can only buy 54 more shares. After all, you have lost €7,000 of your initial capital. Then, the stock price rises to, say, €120. Your stock portfolio is now worth €6,480, a negative return of 35% for you. If you had opted for buy and hold, you would have a nice return of 20%. One more thing to remember when it comes to market timing: often, only relatively few trading days are of outstanding importance for the overall investment success. Allow me to illustrate this, for example, for the gold market. Figure 2 shows the daily price changes in the price of gold, in USD per ounce, in percent for the period January 1, 1999, to January 27, 2023. On average, prices increased by 0.035% per day. You can also see that gold prices have fluctuated significantly daily, with strong up and down swings. This, in turn, suggests that the return on a gold investment over the period under review may have been significantly impacted by price movements occurring in a relatively small number of days. To put this into numbers, we looked at the impact had the investor missed the peak return days. The result is shown in Figure 3. Had the investor bought an ounce of gold, in USD, in early 1999 and held it until January 27, 2023, the average annual return would have been 7.9%. On the other hand, had she used a market timing strategy instead of a buy and hold strategy and missed the 5 best days, i.e. the days when the gold price has risen the most, the annual average return was only 6.5%. Had the gold investors missed the top 10 highest yielding days, their annualized return would have fallen to 5.4%, and had they missed the top 30 days, their return would have been a mere 2.0%. But which days turned out to be particularly profitable? Since you couldn't answer this question in advance, the honest answer is, you don't know ex ante. At first glance, the yield losses caused by unfortunate market timing might appear small and manageable. But that would be a short-sighted view. Even a few percentage points are extremely significant for the investment performance over several years. This becomes clear when we calculate the investment success in USD amounts corresponding to the various returns. For example, had the investor invested $100 in gold in early 1999 and held his gold until the end of January 2023, it would be worth $670, see Figure 4. Had the investor missed the best 5 days, $100 would have turned into only $481. $100 would have only turned into $373 without the best 10 days, and just under $163 without the best 30 days. Apparently, market timing, as in this example, can reduce the investor's return substantially if it is not applied successfully. This is not to say that the investor should not engage in market timing. The investor should only be aware of the special, and often overlooked, risks of loss and consequently only engage in market timing if they are reasonably sure they have mastered it. Buy and hold. The alternative to market timing is buy and hold. However, the success of a buy and hold strategy is not a foregone conclusion but depends on a few conditions that must be met. For example, the investor must not buy too expensive. The shares of the best company, or an ounce of gold, for that matter, are not an attractive investment if they were bought at too high a price. In addition, the investment must generate a cash flow and/or offer the prospect of an upward trend in price over time. For example, this condition is met for many stocks, but not all. What about precious metals, especially gold? Gold does not actually generate any cash flow. But an experience of the past few decades shows this. The price of gold has continued to rise over time, albeit with fluctuations. This finding can be explained, in particular, by the consequences of the worldwide fiat money system. The relentless increase in the money supply it relies on has been shown to drive up the prices of all commodities, including the price of gold, over time. In addition, gold continues to be traded as a close-to-money good. It serves many investors as a form of saving, a safe haven, and a kind of insurance against economic and political risks. Against this background, it is anything but surprising that the price of gold has risen in the course of the relentless, chronic increase in the money supply, as Figure 5 illustrates. Both the money supply in the OECD and the price of gold, USD an ounce, have increased over time. They were on the same wavelength, so to speak. However, the synchronization of the two time series was anything but perfect. And while the money supply increased by 396% from early 2000 to October 2022, the price of gold increased by 481%, or 567% by January 2023. So the price of gold has more than compensated the gold holder for the continued monetary expansion. Looking at recent data points in Figure 5, gold price growth has lagged behind money supply growth since early 2021. Against what has been said so far, in our opinion, the gold price still has considerable potential for appreciation. The increasing problems in the international credit and monetary architecture and the expected upward pressure on the price of gold are not even considered in this assessment. Buy and hold gold strikes us as a viable strategy for the years to come that should prove to be risk-reducing and reward-enhancing for the investment portfolio. The conclusion is buy gold and hold it sufficiently long. Thank you very much for your attention. If you like the video, please like, share, ring the bell and follow Torsten Pollitt's YouTube channel.